In this example, we will look at the repurchase of equity instruments. Assume Targ Limited has 1 million shares in issue at 10 Rand per share. 20% of these shares were issued to employees as part of a share-based payment transaction. Targ Limited now decides to repurchase 100,000 shares from the employees at 10.50 Rand per share, therefore 20 cents above the current fair value. Now first, what you need to remember, what was the original transaction when the shares were issued? Most probably to credit share capital. Now they purchase back these shares. Therefore, we will have to debit our share capital account with 1 million. This is the 100,000 times 10 Rand. We will have to credit our bank with the actual outflow. Therefore, 100,000 times 10 Rand 50, and the difference, the 20 cents difference, shall be recognized in our profit and loss as employee benefits, and this will be 20,000. You will then identify that there is a balancing amount that we need to recognize to our retained earnings to the value of 30,000. Now guys, you need to note that the amount set off against equity will be limited to the fair value determined on repurchase date. The excess above repurchase date will be an expense. Now this is why we have recognized this 20,000 employee cost as an expense. In this example, we will look at share appreciation rights. Therefore, immediately you need to know that this will be cash settled, and immediately you are able to think about your journal entry, debit employee costs if this is a service provided by an employee, and credit your liability. Now, what is extremely important when we talk about cash settled, you need to remember that you will have to remeasure the fair value of your liability at the end of each reporting date. Now, Bala Limited issued 1,000 unconditional share appreciation rights that vest immediately. This is important to us as well, guys, to its managing director on 1 January 2011. At that date, it is estimated using an option pricing model that the fair value of a share appreciation right is 12 Rand. Now, this will be on 1 January 2011, which will be our measurement and grant date, because this is a transaction with an employee. The managing director is entitled to exercise the share appreciation rights at any time up to 31 December 2013, at which date they must be exercised. The fair values of the share appreciation rights increased over time as follows. Now, end of 20.11, 12 Rand 50, 20.12, 12 Rand 90, and 20.13, 13 Rand 80. Now, your first step when you need to prepare journal entries, you need to include your table. Now, what you need to identify, we have included a line for 1 January 20.11, which is the beginning, or not the beginning, guys, but the date that they entered into the agreement. And we have used the fair value on this date. Now, this is cash settled, therefore we need to remeasure our liability at the end of each reporting period. 20.11, 12 Rand 50, 20.12, 12 Rand 90, and 20.13, 13 Rand 80. Important. Then the next important thing that you need to identify is that our vesting period is immediately. Do you see, guys? Therefore, we do not proportion this per year. On 1 January 20.11, the total of our liability amounts to 12,000. Therefore, our journal entry will be to debit our employee cost with the 12,000 and credit our liability with the 12,000. Then at the end of 20.11, when we remeasure our share appreciation rights, our total liability is 12,500. Therefore, a movement increase should be recognized of 500. Guys, the balance should be 12,500, but the balance is 12,000. Therefore, we need to recognize 500 to our liability. We credit the liability and we debit the expense. Then the following year, end of 20.12, our total liability should be 12,900 and it is 12,500. Therefore, we need to recognize the additional 400. We will have to credit the liability, debit the expense. And guys, exactly the same for 20.13. Now let's have a look at our journal entry on 31 December 20.13 when we assume that all the rights are exercised at fair value. Now the fair value on this date is 13 Rand 80. Therefore, when they exercise the right, we need to clear our liability account and we need to pay to our director. Therefore, our bank will be credited.